Did you know that India, which is one of the fastest growing economies in the world, actually has one of the lowest investment grades? Welcome to TOI Business Bytes. In this week's episode, Madan Sabnavis of Bank of Baroda explains the importance of a credit rating, the reasons why India has such a low investment grade, and why there is a very strong case for India's credit rating to be upgraded to the A category. Welcome to the show, sir. Sir, firstly, I'd like to understand from you what is credit rating actually, and why is it an important parameter for an economy or a country to attract investment?
So, a credit rating is a rating which is given to a particular country, which tells you in brief through a letter of the English alphabet as to whether there is any possibility of a default. Meaning thereby that if a particular country is able to honor all its debt commitments, then it would ideally be in a AAA rated stage. And as this ability to service debt keeps coming down, it could keep moving downwards right up to triple B. Now, triple B is considered to be the lowest level of investment grade, and anything below that is supposed to be sub-investment grade. And by the time you come to D is when a country actually defaults on its obligations, then it becomes a default category, that is, gets a rating of D. Now, this particular rating is important from a country, especially so in case you're borrowing from international markets. Now, if you look at a country like India, where 100% of the debt is denominated in rupees, there is actually no global borrowing which is taking place, and any kind of a rating given by the global credit rating agencies shouldn't really matter. But the reason why it affects us is for twofold. One is, of course, it's a reputation issue, because it's become almost mandatory for all countries to be judged on the basis of a credit rating given by the big three credit rating companies. So if I say that India is triple B minus, which is the status which we have right now, it is considered to be just about investment grade. Suppose we move to a rating of, say, A or AA in course of time, then it would be say that the overall credit worthiness of the country has improved. That is as far as the reputation issue is concerned. But at a practical level, individual companies which are borrowing from international markets get affected on account of the rating which is given to the sovereign. It is generally believed that no company can be better than the sovereign. So if India is triple B minus, an Indian company is raising funds from overseas market, we cannot be better than triple B minus. So that is where there is a disadvantage, because you end up paying a higher interest rate because the risk premium goes up. Now, companies which have international dealings, meaning you have your offices, there is a stream of income which is coming in foreign currency outside, can at best get 2 notches higher than the sovereign rating, meaning thereby that if India is triple B minus, a company which has very good operations in overseas market can probably go somewhere towards triple B plus, but you cannot go beyond that on account of the sovereign rating. That's why the sovereign rating is important.
Okay, but sir, if we do, go back in time a bit, a few years back, India was actually at the fear of being given a junk status by credit rating agencies. We were in such a fragile condition. So how far have we come from that?
No, actually, if you look at the performance of the Indian economy, it has been fairly impressive over the years in terms of GDP growth, in terms of per capita GDP growth, in terms of what's happening in the external sector, the way in which our forex reserves have built up. So I think the Indian economy has done very well on almost all economic parameters. And I think to judge the Indian economy, the way I would look at it is, you see that do foreigners have faith in the Indian economy? The answer is yes. If we are getting in one of the largest quantum of foreign direct investment, we used to get around $80 billion a couple of years back. Last year, we got around 70. This year also, we could probably arrive at that same kind of a number. That is, people are willing to invest in a country like India, not really worried about the credit rating, because they see a lot of potential in the economy. Similarly, if I look at the FPIs, of course, the numbers tend to be volatile. But if you look at the foreign investors in the stock markets, in the debt markets, they look at India as one of the better markets to invest in. So when we had quantitative easing in the West and we saw a large quantum of funds which were available, which were invested in emerging markets, India was definitely in the top 3 countries in terms of investment. So there is a lot of faith which is there in the economy, which is based on basis of which people are actually putting the money on the table. But the rating has remained always in this region of triple B minus.
Okay, but taking from what you're saying, that we have very good, robust economic parameters, various ones, and actually India is headed to be the third largest economy in coming years. Actually, uh, US has seen a downgrade. If India is doing so well and it is amidst the global slowdown, then why don't we have a better credit rating? Is there a case for an upgrade there?
So I definitely think that India should be more in the region of around A level. Okay, this is not just speaking because I'm an Indian and I feel that we are doing very well. But even if you look at all the economic parameters and you compare them with other countries in the West, I think India scores very well. I think the only point in which the rating agencies have continuously been harping on has been the fiscal side. Now, even on the fiscal side, I think that why should the fiscal deficit matter so much for the rating agencies, especially when all the debt is in rupees? There is no systemic risk which we are posing to any of the countries in the world on account of our debt going up. And besides, if you look at even our debt levels, while numerically we can say that a fiscal deficit of maybe 5.8% for center, another 3.5% from states does look higher. But I think the yardsticks which should be used for emerging markets should be different from those of developed countries. Because the role of the government is very much different in developed economies compared to emerging markets. Because given the population levels, the level of poverty which is there is more affirmative action which has to be taken by the government, which means government spending has to be up. Now, the rating agencies can always argue saying when you have high fiscal deficits, high level of debt, it comes in the way of private sector investment, the so-called crowding out theory. But that we have seen in the last few years, ever since we had the pandemic and the government's fiscal deficit actually went out of hand, we crossed the 6% mark. There's never been a situation where the private sector was deprived of funds, because I think there's been very astute management by the Reserve Bank of India also to ensure that liquidity was always available. In fact, ironically, I would say there's been surplus liquidity ever since we had the pandemic. So there's been lots of liquidity in the system, and even the interest rates have been kept down, both by monetary policy as well as by the market forces. So it has not really led to any kind of crowding out of private sector investment. So in this kind of a situation, I think that India definitely does deserve an upgrade, and upgrade also of a significant level, not just from triple B minus to say triple B. It's more in the level of around A at a minimum.
Okay, and what reforms do you think, apart from the fiscal deficit, that India needs to take to put up a case in front of the credit rating agencies for an upgrade?
No, I think in terms of reforms, I think whatever the rating agencies are asking for, like for example, the GST, import liberalization, investment liberalization, I think all those things are very much in place. And we say that India is one of the better places to do business. As I told you, that if FDI is high, means investors don't have any problem in investing in India. So I think in terms of reforms as such, I think which are always work in progress, I think the government has been trying to plug all the gaps which are there. But we should remember that India is a federal structure, so we have rules which are laid by the center, which can be addressed by the central government. Individual states have to make doing business easier in their own territories. That, of course, different states are doing their bit on it. The major problem which the rating agencies have is always on the fiscal side. That's not something which we can accomplish overnight. And also we should remember that the parameters which they're looking at, like an ideal fiscal deficit of 3%, is always a case of saying, why should it be 3%? Because I think most of the developed economies, for example, talk of 3%. In fact, when the euro was formed, one of the norms was that you need to keep the fiscal deficit at 3%. But that was for developed economies. So I think we need to be more flexible in terms of these fiscal parameters so that we are able to get about balanced growth. Because I don't think any country, especially any emerging market, can sacrifice domestic goals to make the rating agencies happy. So I think the methodology is something which needs to be looked at more seriously. Otherwise, there will always be a case of the credibility of the rating agencies also. I say so because when you're talking of the American economy, which was just downgraded by one of the rating agencies recently, I think that was something which was long overdue because of the fact, it's only symbolic. It doesn't really make a difference for America. But just think of a situation where America, which is the anchor currency, that is the dollar is the anchor currency, every year you had a problem of, almost every year there was this problem of debt ceiling, possibility that the government would not be able to meet its expenditure commitments. Now, we've not seen this kind of a situation for the Indian government. but this happens very often for US. So I think there is definitely need for these overall methodologies to be looked at seriously. I agree it's very difficult task because when you have a whole array of ratings which have been given to all countries, changing a methodology could be changing all the ratings overnight, which is not feasible. But definitely I think for emerging markets, we need to have different yardsticks when evaluating the rating.